All right. Good morning. My pleasure to call the meeting, seeking addition to order. It's hardly quickly for
Morning, everyone. This meeting of the Sinking Fund Commission is being conducted in person in the Pension Board Conference Room on the 16th floor of 2 Penn Center Plaza pursuant to section 21-1503 of the Philadelphia Code. Electronic recording of this meeting will be made available to the public through Microsoft Teams conference technology. That recording should be made available free of charge at the Commission's website within 10 days. And please note that by attending, participating, or speaking in such you will consent to the report. With that, I'll turn it back over to Don.
Thank you, Christopher. The first order of business is the meeting. 25 Sinking Fund minutes. Is there a motion? A second. Motion has been made and properly seconded. All those in favor, please say aye.
Aye.
Opposed? Ayes have it. Thank you. Second order of business is approval of June 2025 Sinking Fund Commission transfer. Is there a motion? A second. Motion has been made and properly seconded. All those in favor, please say aye.
Aye.
Ayes have it. Thank you very much. Before we get into additional items on the agenda, Christopher, any comments you want to make before we get into the agenda? And auditors part of the fee review and selection.
Yes.
Election meeting back in June.
Yes, so just for the purposes of the record, as Don noted, the Sinking Fund Commission Auditor RFP decision was tabled from the special meeting in June. As a reminder, we posted this opportunity pursuant to all applicable regulations from February 3rd to March 28th of this year. And the incumbent, Lithium Smith and Brown, was invited to rebid. Staff received 3 proposals, and based on that review, we invited 2 in for consideration. ELS and Lithium Smith and Brown. They both made their presentations, and following those presentations, the commissioners tabled the decision and asked staff to go back to the incumbent with them to see if they would be willing to waive a proposed 4% data security fee. That 4% charge annually was going to be in addition to their normal $33,000 a year cost. Staff followed direction of the commissioners and report that Milton agreed to eliminate that additional fee. So their total all-in cost for the audit $33,000 came with. So, for staff, we asked that the audit proceed, assuming that the commissioners don't need additional information, and a selection be made.
Was my recollection that the only thing standing in the way for additional fee. That's been resolved.
That's mine as well, but I won't, Josh was here, Bill, and he said, that's my recollection. Someone was with the auditor. They've been here for a significant amount of time. I want to say it's in excess of 10 years. We did review with them whether or not there was a formal policy that order to stand to be construed without changing auditors. Our understanding is that Bill spoke to this a little bit, that it's just as common or more common to make sure that the partner switches, which they've done, and if they retain Nadia, who's been part of it for the last couple of years, which is to relieve if she would retain all. That's why. So we can discuss that. We did discuss that. Thank you.
So the meeting for each board was motion to
Yes, sir.
review the contract with Wilson Smith and Brown for an additional 100 years.
It's a 1-year contract with up to 4 1-year agreements. Not required. If something happened, we can terminate early. It's a maximum of 5 years.
Is there a motion to retain Wilson Smith and Brown for an additional period of time?
I'll make a motion.
Is there a second? Second. Motion has been made and properly seconded. All those in favor say aye. Aye. Opposed? Ayes have it. Thank you very much. Now, we're going to move to investment performance review and update for 2025.
Thanks. And before I turn it over to Waco, I'm going to go through the June performance as well as touch on the benchmarking question that was raised for Sky Marker at a prior meeting. I just wanted to note that total assets in the fund as of this morning, around $697.21 million. That includes north of $11 billion in cash for roughly 4.5 to 5 months of benefit payments. That we do to review performance and answer questions for the commissioners.
Great, good morning, everyone. And we have a June 2025 market environment. So before going into portfolio performance, I thought it would make sense just to touch on a couple of things regarding the asset classes we've had spoken to, how they have behaved, how they performed, and how they performed essentially. The good news is the second quarter was a very strong period for the markets. Our 1-year number exceptionally strong in the double digits. And, we'll see that the volatility of the first quarter, at least for the second quarter period, was in our rear mirror. So that's the good news as we think about the macro environment, and we think about the performance that will go momentarily. As we know, these are interesting times. So as we think about macro policy, we expect that to be a source of volatility on a go-forward basis. Discussions around tariffs are taking place even now. And the discussions around tariffs, we think about tariffs injecting uncertainty into the market. The market not liking uncertainty. They think about more volatility every time the tariffs are put to the table and so on. But trying to, let's see, this is going to be on page 3 very quickly. Page 3 just points to the calendar year returns for the various asset classes. When you look at this in color, you'll see that each box in a periodic table corresponds to a certain asset class. And the takeaway here is what's on the top on any given year may not be the top performing asset class. What's on the bottom of any given year, I think with the exception of the commodity that provide that trend, but what's on the bottom of any given year may not be the bottom performer. So the takeaway here is diversification is really the key thing for a sound investment program and for a long-term perspective on navigating markets. So page 4 takes us to various asset classes and the ones that we have more in the way of direct exposure to. And you're going to see for the quarter as well as year to date, with the exception of domestic small cap, everything is in the positive. So again, some of those terrific numbers we saw during the first quarter, Liberation Day really being the result of the sell-off. Again, that's in our view as we think about the second. So the S&P 500 had a very good second quarter of 10.9%, taking it year to date to 6.3%. And the reminder here is if you look at that 10.9%, then it gets you a 6.2% result year to date. It is telling us that going into the second quarter, we're looking at negative results for US equity market. That's the great takeaway there. The international markets have continued to perform pretty strongly, and for the first time in recent memory, the international markets are comfortably outpacing the domestic market. And there are a couple of reasons for that. We have the dollar depreciation, for example. If you look at the comparison of the global versus the, which is the middle of the page, you'll see that the local currency return of 7.8%. So this is the return of the index in foreign currency terms. When you convert that or translate that to US dollars, that actually gets 19.4%. So basically means that the dollar becoming weaker per unit of foreign currency in dollar return. That's been one of the tailwinds we've seen for the international markets. Another tailwind for the international market has been, I guess, the reinvestment in infrastructure, whether it's military, whether it's from the housing, transportation standpoint, just a little bit more spending, what we're seeing overseas. That also has helped spur stock prices that we think about in the non-US market. Fixed income has definitely been in a very delicate place post 2022. So what happened in 2022? We saw the Fed begin to raise interest rates pretty tremendously. That was to combat inflation. So, as a result of the stimulus we saw in 2020, COVID, also in 2021, we saw more inflation. And one of the ways to combat inflation is to make things more expensive. Make those things more expensive by raising interest rates, what the Fed is looking to do. So if we think about the fixed income market right now, there's a lot of delicateness in fixed income. The market is really looking at and hoping for interest rates to come down. However, as economic news continues to come out, that either bodes well for the economy, shows that there's still a little bit more inflation, that will lead to some sell-off in fixed income. So ultimately, fixed income, we expect a little bit more volatility, but at some point, the market is pricing in interest rate cuts. So right now, it's 2 interest rate cuts that are being priced in for 2025. So moving ahead, page 5, I won't go through that in much detail, but just so you have it, it's a dashboard that points to, how our research teams views on the various asset classes, where there's a tailwind that points to, okay, there's something positive built into the market or into the dynamics of the asset class that we view as very positive. We just mentioned fixed income and the fact that rates could, in fact, come down in 2025. That would be a tailwind because there's an inverse relationship between interest rate levels and the value of your fixed income. So rates come down, you expect fixed income to rally. That would be a tailwind. You will also see, for example, the international markets, there are tailwinds built in there. And then as we think about the equity markets, you're going to see more of a neutral stance with the equity markets. On the one hand, we get economic news that's pretty positive with respect to, whether it's production numbers, whether it's hiring numbers in general. But then you'll have other news releases that point to smaller companies perhaps retrenching and not being as resilient with spending. So a lot of mixed messaging about the points more neutrality as we think about the equity markets. Page 6, PCE. This is a measure of closing consumption expenditure. This is a measure that the Fed has looked at for the last number of years, and looking at the 2% long-term trend is really where the Fed views things in terms of being in a happy state. Anything significantly above 2% would mean that we have more inflation than perhaps is desirable. So again, as we think about where interest rates are, part of that has been to get this PCE number to that 2% magic number that the Fed has. With respect to some of the other indicators, page 9, really quickly, and page 8 as two comparisons. You'll see that labor market growth better than expected in June. This is on page 8. And to my point earlier, smaller companies ratcheting down on hiring. So some of these mixed messages just lead to a little bit more volatility in the markets and what the markets are reacting. We move to page 11. It's actually over the beautiful. So that's what's in the landscape. What we think about the bill that we recently passed, a little bit more in the way of, I think, uncertainty as things do take hold, particularly as we think about healthcare, particularly as we think about those that are concerned around deficit. So page 11 to some of the key takeaways from the taxation standpoint from the bill. And when we think about the bill, on page 12, like the add to the deficits, I think I'll probably add our research for that in. So I think by all measures and all analysis, it's expected the bill would add to the deficits to the tune of 3.4 trillion. That's really just revenue and expenses issue. You're spending more than you're bringing in to end up increasing the deficits. That's really the takeaway there. So as we now move to page 14, very quickly, interest rate cuts on the expectations. This is the market and the market's expectations here. Those market expectations can go up, they can go down. So, the health of the economy, I think, will also determine how realistic this 2 interest rate cut projection is. If we do see a little bit more of a slowdown, if we do see CPI and other measures of inflation come down, perhaps a little bit more tremendously, you can probably look at a higher than 2 interest rate cut projection for the market. And if the market does continue to be more resilient, we can probably expect closer from 0 to 2 subject to rate cuts for 2025. So the big emphasis here is on expectations, and as the macro data comes out, most of those expectations, we expect the market to sell off or rally based off how close we are to an interest rate cut. The market likes interest rate cuts, so the more realistic an interest rate cut is, the more we can expect the market rally. The more it appears that interest rates would remain where they are, we expect more volatility, and particularly on the fixed income side.
But tariffs impose the fact that on inflation,
Yes,
so it should push it up.
correct.
So that means that the Fed, in all probability, to delay reduction of
But potentially, so on the one hand, tariffs are inflationary in nature because they're a tax. So you increase the input cost, you increase the purchase cost of a good or service, that's inflationary in nature. The flip side of that is if the cost goes up to a point where people aren't buying, people aren't transacting, that that inflation could lead to less demand. And that less demand could lead to more of an economic slowdown. So that's kind of the balance when we think about the knock-on effect from the tariffs and those being rolled out. And that again points to the volatility and uncertainty that comes with tariffs. Because if on one day tariffs are rolled out and let's say you're a fourth quarter company, you're budgeting your input costs, your sales costs, your forecasts based on those tariffs being rolled out. And then let's say a week later, that's rolled back, all of a sudden, the uncertainty, the volatility, the hiring, that's where the noise comes in. So yes, tariffs are inflationary in nature, tariffs are a tax, but the knock-on effect could actually be deflationary if you think about lower demand and then less economic activity, which is more expensive to transact on for this information. Page 16 takes us to fixed income. Fixed income, the exposure we have is on the intermediate side as well as high yield side of the curve. And as we think about intermediate also some ag exposure, we take a look at this segment of the market. You can see fixed income year to date up 4%, for the quarter of 1.2% in the index. The intermediate index is going to have a shorter duration, so it's been a little less sensitive to some of the fluctuations that have happened in the fixed income markets. You'll see that intermediate is actually holding up very well versus the ag index. And then high yield, as we'll see momentarily, the equity markets have done exceptionally well. High yield typically has a good correlation with the equity market in terms of positive correlation. So as the equity markets have done well, high yield has been sort of that rising tide. So up 4.6% year to date for the quarter, up 3.5%. Moving ahead to the equity markets, jump to page 21. On page 21, we've seen some pretty solid performance from the U.S. equity market. Year to date, pretty much in line with its core value growth. So we've had this very interesting horse race where the market sold off during the first quarter, value did very well. The market rebounded during the second quarter, did very well. Net, they're essentially in a very similar position. We think about the year-to-date result. That also takes us back to that neutral outlook that we have when we think about headwinds versus tailwinds versus looking at things neutrally. There's a lot of noise in the market presently, and that noise makes it very tough to either favor more growth or value difference on any given day. If tariffs are rolled out, you can expect your value stocks to do better because, again, these are your companies that have less leverage, they have more cash flows. And then if you think about tariffs being rolled back, think about growth companies doing better, and then core similar. And also the noise of this macro environment, again, does point to us favoring equities, but it's really hard to say in comparison to, let's say, a year like 2020, 2021, when rates went down tremendously. You could say, okay, it's going to be very, very well. It's very tough in this environment to say, okay, this is going to be the era of growth for that. As we think about the cap segments, so you think about large cap, mid cap, small cap, your large cap companies, these are Microsoft, NVIDIA, Johnson & Johnson's, multi-billion dollar companies. Your large cap companies have done pretty well. It's a big period. Your mid cap names, I think Chipotle is still up in mid cap. So you can think about Chipotle as a mid cap stock, and then small cap, you can think about Buffalo Wild Wings. Mid caps have outperformed small caps, but large caps have really held up pretty nicely, just given the volatility that we've seen in this environment. Page 22 just takes us to the S&P 500. So you'll see from a sector standpoint, year to date, many of the major sectors are actually performing pretty well. The one really surprising thing I'll point to here is energy. So during the quarter, we saw interventions and we expected energy prices to go up. Anytime there's escalations in the Middle East, particularly around oil routes and so on, you expect the price of energy to go up. That didn't happen. So surprisingly, during the second quarter, we saw energy prices go down. Jumping into the international markets very quickly. So on the international side, on page 28, once again, international markets have had a very good 2025. Part of that is mean reversion. We've seen the U.S. equity market dominate for such a long period of time. Everything does mean revert to some degree. But outside of the mean reversion, international markets have definitely been helped by the dollar depreciating, and then ultimately more in the way of inward-looking investment and deployment of assets, whether it's on military, whether it's on infrastructure. All of this has been beneficial net to the international market. So versus the U.S. market, where the U.S. market was up 6% year to date, the international market is basically triple that when we think about the 19.4 and 17.9 getting between equity ex-US. So I will pause to see if there are any questions over the market environment. The takeaway here is the second quarter was definitely a much nicer quarter for the markets. First quarter, actually, that's never really been right. Third quarter, we don't what's going to this quarter just because fixed income is currently down. Equity markets have been a little bit more volatile, and it's really just that mixed noise, the mixed signals around tariffs, some of the economic data coming out. earnings will be coming out as well. So all of this will determine, I guess, how strong the building will be.
So anybody can put it. Ed share the impact markets is removable.
So quick answer is if there's any type of removal or direct hand on the Fed shares, yes, the market I think would look at that negatively just because the Fed is supposed to be independent and being so overtly replaced and what have you, that would inspire confidence in the markets. One of the reasons why the US has been downgraded by all the rating agencies has been concerns around politics, stability of institutions, and so on. And I think that will just kind of feed into those narratives, so that wouldn't do good. So that's what happened, but that's been a little bit more understanding it. As we jump into portfolio performance, we'll jump into performance report, and I want to this is page 4. Very quickly. So on page 4, for the quarter, you'll see that we had really good quarter, up 7.7%. Year to date, up 7.1. We're a little bit behind the benchmark. So we think about the sell-off that took place during the first quarter, having a little bit more of a tilt, for example, in smaller cap relative to the broader market. That would have been a relative attractive for us. But as we can see, we have more than caught up as we think about the market rebounding. As we look further out to the right-hand side, we continue to see tracking where we're actually in line with or doing a little bit better than the index when we think about 3, 5, and 10-year as well. And the 1-year number that we've been impacted a little bit just by the sell-off that we just described at the beginning of this year. But all in all, these are really, really solid numbers. And as you think about this performance stream, I think many plans would happily take these numbers going towards one. So that's a really good thing if we think about the overall performance, the absolute and relative performance of the portfolio. If we think about the allocation versus the target, we're not looking at anything seismic when we think about overweights and underweights. Domestic equity, 70 basis points in terms of the overweight. International 2.7% globally, and then fixed income at 3.3%. We see everything all in line with policy ranges. And then, as Chris mentioned, through yesterday we were at 697 million. So the 691 million, even though the third quarter has been a pretty rocky period, as we think about the markets, we're still up. So definitely encouraging numbers when we look at the numbers on this page. The gain and loss versus net cash flow, quickly hitting on that. This is also a pretty good thing. If you think about what these numbers are telling us, it's basically telling us that the earnings of the portfolio have significantly outpaced any type of redemption or cash flow. So over the 3-year period, for example, 81.1 million has essentially been liquidated in the portfolio, that we have gained 227.2 million over that same period. So significantly outpacing the liquidity needs. So with that, we'll jump into portfolio performance. But if there are any specific exhibits you would like me to jump into, please let me know. But on page 8, we take a look at the various components, and you'll see fixed income really holding its own. Year to date, up 4.1%. Part of the overall performance here has been helped by one of the managers, Garcia Hamilton. This is a manager that makes pretty aggressive duration bets relative to the index. Whenever rates are poised to come down, the market's projecting rates to come down, you can expect a pretty nice rally from this manager. Whenever rates go up or expected to stay up, you can expect this manager to see some pretty sizable tracking relative to the index. So going back to the market forecasting those 2 interest rate cuts, that type of views, that type of pricing would be a pretty nice tail like Garcia and Hilton. So they're up 5.2%. And then you'll see here, MetLife, the investment grade, the intermediate strategy also holding up pretty well, just given that it's had less sensitivity to the noise around where interest rates are going to go. But all in all, the fixed income composite holding up nicely at 4.5%. Momentarily, we'll discuss Pew Capital Management. So this is the legacy Sky Harbor allocation. This strategy is a high yield strategy. Now, high yield, you can think about non-investment grade fixed income. This is the type of fixed income that is correlated more with the equity market. Now, within high yield, you have different flavors of high yield. You have aggressive, and you have your more conservative managers. We would consider the Pew strategy to be more conservative in nature. As it's more conservative in nature, there will be periods where they lag for the index. That's one of the reasons, or the main reason I should say, we're discussing the addition of a secondary benchmark. So in a moment, we'll discuss their overall performance and their positioning relative to the index. Page 9 takes us to the equity markets, and you'll see here the index funds performing in line with the benchmark. So nothing here to really report. PineBridge, they've continued to hold up relatively well. Now, there is an active component to this strategy. So you'll see, year to date lagging a little bit. So they work a little bit during sell-off. But you'll see for the quarter, they were more or less in line with the index. On the small cap side of things, you'll see that Copeland continues to lag the benchmark. But quick reminder with Copeland, we are transitioning away from the small cap strategy to that SMID strategy. We feel that the SMID strategy will just give them a little bit more room to maneuver and go up and down the cap spectrum. And the Bromline small cap core index performing in line with the benchmark. The international composites, really good performance coming in from both Canadian and British funders. And Bromline looking at both managed performing in line with the benchmark. So all in all, no major surprises to report on the management lineup. There is one recommendation that will be made momentarily with respect to managers, but that's really to add a secondary benchmark to the an index that continues to reflect more conservative nature versus the broader index. If there are no questions on the report, we can jump into the memo on Pew, which is the legacy Sky Harbor capital management strategy. Really the same theme with the name change of Sky Harbor was merged or acquired by Pew. So in the memo, we highlight here that Pew is evaluated against the Bloomberg US Corporate High Yield Bond Index, and this is the core high yield index in the market. Now, the lettering is a little bit small, but you'll see this in our quarterly reports. We have characteristic pages that compare for us our managers relative to the benchmark. And in the case of Pew, you see relative to the Bloomberg High Yield Index, you'll see that Pew has an overweight to triple B plus securities. They have an underweight to double B holdings, and then they have an overweight to single B holdings, and an underweight to triple C holdings. What does this all mean? It means that when we look at the credit profile of Pew versus the high yield index, Pew is going to be a little bit more. So in environments like this where markets are a little bit bullish, stocks rally, and by default, your high yield credits are also rallying in the same manner. You may see a manager like Pew lag the benchmark. So lagging isn't a bad thing. It's not something that is actionable. So if they're taking less risk is being rewarded, they're going to lag the riskier benchmark. So one of the things we feel will kind of help level set and give some context to that performance would be the addition of a secondary benchmark. And the secondary benchmark that's being recommended is the ICE Bank of America double B, single B, high yield index. The double B, single B, high yield index will take into account the fact that a manager like Pew is pretty meaningfully underweight to triple C. They have the bulk of their exposures. If you look at the average credit between double B and single B, so that makes it more of an apples to apples comparison for a full market cycle. So that would be the recommendation. And happy to take any questions that there are.
We're just moving from one index to another.
So we're going to keep the main index, which is the Bloomberg High Yield Index, as well as a secondary benchmark, which will allow us to, in environments like this, gauge how Pew is doing from a quality standpoint, and then in environments where the broader high yield market itself, Pew hopefully holds up better than the broader market, will also give us some context around their relative outperformance versus the index. So it's the addition of the secondary benchmark to help us over a cycle.
It's similar to what we've done with our C2 benchmark.
Is there action that we have to take to accommodate that?
I don't think so, assuming everyone's comfortable with that. Fine.
Yeah, so going forward, you'll see those two benchmarks. We can just have a great discussion there on the high yield market based on that.
The only, just two things, one, just, the piggyback on what Wade mentioned about the transition to the SMID, strategy was completed on July 7th. So, we'll start to see that reflected in the portfolio going forward. You'll recall that's a slightly lower fee for that product as well, so that will also help with our returns. And then just a reminder, this meeting is scheduled for September 17th, and that will include actuarial presentation. So if those folks will be here to review the funding level and associated topics on September.
So that's going to be an in-person meeting.
Yeah. But I should add, as long as one person is here, there's still the option of nothing limiting the sunshine. Others from attending virtually, so there's no prohibition. Share one person here. That's all I know.
Okay, Carol, is there a motion to adjourn? Will do. Thank you very much.
Thank you.